Everyone on the call. So my name's Sam Bickerton. I'm the regional BDM at Pepper for the Southeast. I've been here for around about 3 years now, and previously spent my time with a couple of different lifetime mortgage lenders before that over the course of sort of 12 years previously. But being at Pepper Money, it's a really, really interesting place to be a BDM because we say yes to so much. And I'm not just talking adverse credit, I'm talking about, different, we'll listen to a bit of a story. So one thing we do every year is we carry out something called our specialist lending study. So it's now in its ninth edition. And this covers everything from adverse credit to first time buyers, self-employed, everything you can think of. It's a 60 odd page document that I'll share with you afterwards. But it gives us a bit of an interesting insight into where the nation is, if you like, as a collective, and the size of the market that we're operating within. But more importantly, what the study is about is for you as the brokers to see the size of the market off the high street and the fact that it is growing year on year. So we survey something like 5,000 people throughout the UK in conjunction with YouGov. So it's a really robust study that gives us lots of interesting insight. And that's what I was hoping to share with you today. Okay, so I'll cover a little bit about people's aspirations to home ownership, and basically it'll feed into some various different stats, and then finally I'll finish off with how Pepper can support you going forward. Okay, so sorry, my slides aren't tallying up, but I'll just have to work off one screen. Let me shut that one. Can you sorry. Right, perfect. Hopefully you can still see my screen okay. Yeah. Oh, blimey. Do you know what? I'm going to stop sharing and start again. Share one more time. Okay, so let me just work off one screen. Right, perfect. So yeah, as I say, what I'm going to do is cover a little bit about the current market, the impact that it's having on customers, and then finally it will plug into kind of how specialist lenders, not just Pepper, but specialist lenders as a whole, can support you going forward. So just talking a bit about aspirations for home ownership. So we think that 61% of non-homeowners do aspire to purchase a property at some point. And if you look at it, if you break it down by generation, actually it's the younger generations that have that desire, because I suppose if you're older and haven't owned a home, then your desire to do so probably gets less and less. But the key takeaway here is that actually that younger generation, 85% of those who aren't homeowners do intend to own a home at some point. And we think that 1.2 million adults in the UK expect to be in a position to buy their first home within the next 12 months. So more and more people are going to be out there actively looking for homes. So we think, obviously, as I say, within the next 12 months, 1.2 million. But if you look a little bit further, up to 5 years, you can see that there's massive numbers of people that are looking to kind of get on the ladder. And if you break it down by employment type, what's interesting is that the self-employed are by kind of employment type have the biggest desire to get onto the property ladder. So you can see 80% of the self-employed desire to be a homeowner in comparison to 73% of the employed. But what I suppose the scary stat leading on from that is that 76% of people, according to our study, who are self-employed, think that it's going to be more difficult for them to get a mortgage just through being self-employed. And maybe there is a bit of truth in that. I would say one of the main things that you'll find with specialist lenders is that we can really help people who don't have just your normal standard employment types. Maybe they need to use a bit of, their variable incomes or 1 year self-employed and things like that. But we're finding that the cost of living crisis is obviously continuing to rage away in the background. So some of the key takeaways from this year's study, we found that 14% of respondents had taken on additional work as a result of the cost of living crisis. When we did the study last year, that was at 10%. So you can see that more and more people are having to take on additional work just to kind of get by at the moment. 57% of people said their disposable income had decreased, and over a quarter said that their income had decreased significantly year on year. So more and more people are coming out of those lower fixed mortgage rates. You know, the 5-year deals coming to term at the moment might start with ones and twos. That's going to double if, you know, based on kind of current rates. So we're finding that obviously there's less and less money to go around. Everything's going up: food bills, energy bills, travel costs. You know, naturally there's just less money to go around. The more and more people are actually having to borrow just to kind of get through at the moment. And obviously all of that's lending itself to that bottom stat there, that over a third of respondents said that their financial situation was negatively impacting their mental health. People's budgets are being squeezed, and this isn't just sort of low earners. What's interesting is that we asked, would £100 increase in your bills have an impact on your ability to basically cover them on a monthly basis? And something like 72% average said yes, it would. You know, £100 would make a difference to us. And we're not just talking low earners. Obviously, if we look at by income group, the low earners are the highest affected. But what's interesting is that it goes in, and actually those real high earners, it kind of tails back out. So 64% of those, 60% of 100,000 or more earners said that actually £100 difference would have an impact on their ability to cover them. So I think that's quite interesting, that obviously people just live to their means, and no one's averse to adverse, if you like. All it takes is someone to be made redundant, to be hospitalized, or go through a divorce, and all of a sudden more and more people are falling into these categories. We think that 16.6 million adults in the UK have experienced some form of adverse credit in their lifetime. So that's almost a third of the adult population have experienced adverse credit, according to our study. So yeah, almost a third, so 30% within their lifetimes. And this is the kind of things that we're seeing on credit files. Obviously, you've got your real common stuff like missing credit payments, all the way to your less common stuff like missing secure payments and that sort of thing. We further to that, we think that 9.3 million adults in the UK have experienced some sort of adverse credit in the past 3 years. So that's almost the scariest stat, in my opinion, because, you know, if you've had it in your lifetime, it might have dropped off your credit file. But if you've experienced adverse credit within the past 3 years, then you are going to struggle to get a high street mortgage. And I know that some of the banks will kind of open and shut those floodgates as and when they kind of feel like it, sort of almost putting a screwdriver in the back of the credit score system. However, you can kind of basically say that a lot of these clients might end up in the specialist market, you know, having to come to a specialist lender. The idea really behind someone like Pepper Money is your client's not going to be with us for the long term. The likelihood is you're going to be with us for no longer than 5 years. You'll come to us for the short term, you know, whether that's a 2-year fixed, a 3-year fixed, or a 5-year fixed product, while something drops off your credit file, or once you get another couple of years books, and you're going to find yourself back on the high street in no time, is the idea. Just back on the kind of missed payment side of things, though, we found that 15% had missed a payment within the past 3 years. Yeah. So this is, again, the sort of things that we see on credit files. So I think I'm not going to go through it all individually, but on the left-hand side, you can see that 67% of those who'd missed a payment had gone on to miss more than one payment. So where we get quite often is, oh, they just didn't set up a direct debit on the credit card or something like that. To be honest, if you're missing more than one payment, that doesn't suggest that you just haven't set up a direct debit. That suggests that either you're struggling to stay on top of your bills, or you've missed one payment and you've decided, well, your credit file's shot anyway, now you might as well just let it kind of slip. But these kind of one-off missed payments aren't even adverse credit to a lot of specialist lenders, and the likelihood is that we do the vast majority of our business on our best products, which I'll go through in just a sec. So 10%, so 5.57 million adults in the UK had missed a credit card payment in the past year, so a real chunk of the population. But that's where you guys come in. So according to our study, of those with adverse credit, only 47% of respondents said they would even speak to a mortgage broker. That's a really scary stat, to be honest, and it's back from 50% the previous year. We need, as a lender or a specialist market, for every client with adverse credit to be speaking to a mortgage broker, because maybe they speak to their bank or their mate down the pub thinking, well, there's no way I'm going to get a mortgage with this default on my credit file from last year, not realizing that not just Pepper, but there's, dozens of lenders out there who can help. And as I said before, it's not that you're going to be with us for life. You might have to pay an extra percent on your interest rate for a few years, but actually we have got an option for your client to either buy that home or stay in their home. So it's really, and the whole idea behind this study really is for you guys to realize the size of the market, and hopefully when we do the study next year, it'll be back up, past the 50% mark of those who would speak to mortgage brokers. So it's interesting to see how much people think they would need as a deposit. So according to our study, well, a scary amount of people didn't know what they would need as a deposit, but 15% of respondents thought they'd need at least 20% as a deposit. 25% were kind of around a little bit more on the money, with thinking that you need at least 10%. But yeah, it's just changing those misconceptions and making people realise they do actually have an option. So as I said before, only 47% of those with adverse credit would even speak to a mortgage broker. If you break that down by kind of age range, if you like, it's encouraging that the younger potential applicants might actually be reaching out to you. I think it's just that awareness, maybe they see more online and that kind of thing, but the chances are that actually the younger generations might be reaching out to you more than some of the older generations. And then just a really common misconception: whilst 2/3 of respondents from the survey knew what a CCJ was, nearly 1 in 5 thought they'd have to wait for over 5 years for that CCJ to literally drop off their credit file to then apply for a mortgage. I think that's a really common misconception, that if you've got a CCJ, it needs to kind of fall off the file. To give you an idea, we'll do it from 4 months onwards from registering a CCJ. So even if it's really recent, your client will have an option. And according to Registry Trust, over 1 million CCJs were registered last year. So there's scary numbers of CCJs, so that's not necessarily 1 million clients, because there will be some duplication in there, but you would say that 750,000 at least adults out there have registered a CCJ last year, and that is going to mean that they will no way be able to get a high street mortgage. So there's going to be more and more of a need for people like us, and we'll, as I say, we'll do it from 4 months onwards. But what I was going to go through in a little bit more detail is just some of the other ways in which specialist lenders, and specifically we, can help, because there's almost, as I say, adverse credit is a massive part of what we and other specialists do. However, it's not the be all and end all. One thing I hear all the time is, we don't do your sort of business. We only do vanilla. And that's fair enough. Yeah, that's a great place to be. But the first thing I would probably say is that vanilla clients are getting less and less. There's more and more of a need to use extra incomes, and more people are experiencing little blips on credit files. So just briefly to explain how our products work. So we don't do any credit scoring at all. Okay, so credit scores mean nothing to Pepper Money. We will only use Equifax. So we'll do a soft check at decision in principle stage, and that will feed into a product. So once you do your decision in principle, you don't input any adverse credit. We will just come back to you and say, you qualify for this product, and that is because either you've registered a CCJ, a default, or a missed mortgage payment within the past 48 months. If you haven't registered one within the past 48 months, you're going to be on our best product. And it's interesting to know that 60% of our business is actually on that cleanest product, with the rate starting from sort of early fives. So we're not a million miles away from the high street. And I think that's another kind of misconception, that specialist lenders you're going to have to pay kind of through the nose for the privilege of coming to a specialist lender. The bulk of our clients actually do fit on those slightly cheaper rates anyway, and we can get up to 90% LTV. So as long as your client's got a 10% deposit, you're going to have an option. Anything unsecured in terms of missed payments actually doesn't even constitute adverse credit to Pepper Money. It's not until you default on a line of credit that actually then it feeds into these products. And it doesn't matter how many CCJs or defaults you've had, or how much they're for, or whether they're satisfied. It's just, when was your last one registered? If that was 2 years ago, you're on Pepper 24. If it's 3 years ago, you're on Pepper 36, because this is just months. And I mentioned before that we'll do a CCJ from 4 months onwards. Defaults and CCJs we can do on Pepper 6, from 4 months onwards, with it being 6 months of completion. So even if you've got really recent adverse events, we will be able to help. I'm not going to get too bogged down in our products though, but just so it's not all adverse. There's other reasons that you're going to end up off the high street, and they're going to be around affordability. So we can do 1 year's trading for self-employed applicants, and it could be that you've completely changed careers. On the flip side, we will always use the latest year's figures for affordability. So you might find that some lenders, slightly cleaner lenders, you might try someone like Coventry, who will say, yep, we'll use the latest year's figures. But actually, if it's jumped by more than a certain percentage, they won't. They will want to average it back. With Pepper Money and potentially other specialist lenders, you'll find that we'll take more of a kind of holistic view and actually underwrite in the way that, okay, can you just explain the jump if there has been a jump? If you can explain it, brilliant, that makes sense. This is the new norm going forward. We will use the latest year's figure. So as you can imagine, for affordability for the right client, by the time he times that by 5, we can lend way beyond whatever anyone else can lend just by using that latest year's figure. We can also use net profit for limited company directors. Yeah, so most people use salary, net profit, and we also add back in pension contributions for any limited company controlling director. And again, that can make a huge difference for affordability. If you've got someone put in 20, 30 grand a year into a pension, by the time you times it by 5, there's a lot more lending. The other thing that you'll find is that because you're unlikely to be with a specialist lender for more than really 5 years, as I said at the start, we can be a lot more flexible about using earned income into retirement, because unless your client's kind of into their 60s, the chances are that your self-employed builder isn't going to be with us at the age of 75 anyway. So it's all about just stretching out that term as much as possible and bringing those payments down to a level that's achievable for your client. If you do have a self-employed builder who's 70, we might then just ask a few more questions, but it might be that they run a building firm but aren't on the tools, if you like. They just kind of price the jobs. We will listen to a story. So the most important thing that you'll find with the specialist market is that you can speak to underwriters. Okay, you don't have to. There's not so much back and forth and having to wait days for responses on things. You will just pick up the phone, have one chat, and you'll find that you can get cases signed off almost instantly, because we will just listen to that story and mark it off there and then. The other things that we're very good at is using any variable incomes. And I said that at the start, if you're looking to stretch incomes, second jobs, I mentioned that 14% of respondents have taken on additional work. So taking second jobs at 100% can really help. And we only need 3 months in any second job to be able to do that, as long as it's plausible. 100% of any monthly commissions, bonuses, overtimes used. We just average the last 3 months on those. And it doesn't matter if bonuses or commissions or overtimes outweigh the basic pay, as long as you can explain it again. And just one last thing to mention, I don't want to waste too much of your time on talking about our products, but interest only. So if you've got clients that have come to the end of their interest only term and can't get an extension, maybe have looked at a lifetime mortgage and can't achieve what they need on that, they just need to get themselves from 65 to 75. We are a very good lender for that, because we don't have any of the normal restrictions around minimum equity or minimum income, or stressing it against repayment. It doesn't matter if you're taking a 5-year term to go from 70 to 75, the affordability is going to be based on pure interest only. So it's just a way really of keeping your client in their home for another 5-10 years before they maybe come into some inheritance, or maybe look at a lifetime mortgage, or maybe they're ready to downsize. So again, just bear us in mind for interest only as well. The only difference is that the LTV is capped at 60% on interest only, and we don't do a part and part. So you need at least 40% equity for us to be able to do it. But just to kind of round off, I suppose, because this is what is the most important thing, and I've already covered a lot of this on the way through, but what you'll find differs between us and even other kind of specialist lenders really is that as much as it's manual underwriting, it's very quick. So the most important thing is being able to speak to that underwriter. Okay, say you get a new case on your desk, please do reach out to me. reach out to your telephone BDM. But if you can't get hold of us because maybe we're in a meeting, even if you call the main reception line, the people that answer the phone are underwriters and they answer within a minute. So you'll never have to hold, and you can always speak to someone who knows what they're talking about. And what you'll find with specialist lenders is that we work a lot in those grey areas. So don't necessarily source something and think, doesn't look like it's going to be one for them. It's always worth running it by us, because you will find that we've got a little bit more autonomy to be like, actually, it's a strong enough case. I think we're going to be fine to do that. And if we are making exceptions around policy, those are agreed at decision in principle stage. So run that soft footprint decision in principle. We will, maybe 2/3 of our dips refer. Please don't panic if you get a dip referral with Pepper Money, because actually we take about 20 minutes on referrals. It just means that an underwriter's giving it a quick once over before we make you pay any fees or put any footprints on any accounts. So we are very good at, just when we say yes at decision in principle, we mean it. The product that you're given at DIP doesn't change. So it's based around your credit file. We'll pick up any issues when we do the soft check with Equifax. This is the product. There's no scoring or anything like that. So if you just need to get a decision in principle for a client, because sometimes, to be honest, if you're having to stray off the high street, that's half the battle. It's like, can I actually get this client a mortgage? And then you can almost work backwards from there. So what Pepper Money are very good at is, if we say yes, if we say no, you can almost be sure that pretty much every lender is going to say no, because we'll do everything from just miss the high street on credit score or affordability, all the way to someone who's had 20 defaults and 5 CCJs registered that are all unsatisfied. We will do everything in between. It's just whether you're on our kind of best or our worst product, if you like, and we will tell you what that product is once you do your soft footprint dip. So then it's back to the client, does this work for you if all else fails? If the answer is yes, brilliant, then we can start moving forwards. If the answer is no, then you might consider trying to find something a little bit kind of cheaper. But as I say, we're very good, even if it's just as a backstop. Look, I've got you a mortgage sort of thing. The other thing that we can do is free desktop valuations at dip stage. So you might have someone who's got a bit of a kind of, you're wondering whether the property is going to cause issues at valuation stage. Actually, you might find that we don't send the valuer out anyway. We will just do a free desktop valuation at dip stage. So by the time you've done your soft footprint dip, you'll know that the credit's done, the valuation might have been done. As you can imagine, there's not loads to underwrite by the time you put the full application in anyway. But once you do, then your underwriter is your case owner, and they'll do an initial underwrite, usually same day, but certainly within 24 hours, and be on the other end of the phone to you. And if you needed to speak to them at any point, you can just do the main line, option 3, and they answer within 30 seconds. It's your underwriter. So if you were to think, if you're a bit concerned about doing business off the high street, hopefully this sort of stuff gives you a bit more confidence that actually the service is good. It's almost better than high street, because you can always speak to someone, and it's not that you're having to wait days for things to be picked up. You can just always speak to someone, and things do move forwards. And we get about 90% of cases through to offer. So the other concern is, if I go off, will I waste a load of time with someone who's over promising and actually they're never going to get it through to offer anyway? If it passes dip, you can be pretty certain that it's going to get through to offer with us anyway. We will generally find a way. And that 10% drop off tends to be more around property. It's like, the value has gone out and it's a steel framed cabin, or something like that, no one was going to mortgage anyway. Once you get to offer stage, we offer free legals as well. So this is a really good thing as well, because you might find that a lot of people who come to us do an element of debt consolidation. So you do have an option of using your own solicitor. However, what we are very good at and sort of pride ourselves on is that we actually clear the debts. So say you've got a client clearing 5 or 6 credit cards or loans at completion, we will instruct the solicitor, get all the reference numbers, give them to the solicitor, and make sure that everything is physically cleared at completion, so that your client's got a clean slate. I know, well, I can't remember what lender it was, but they did a study recently, and over half of those who said they were doing debt con didn't actually clear the full debts when the money was released to them. So for us, obviously a bit of a generalization, but if someone's ending up with a lender like Pepper Money, it's safer to make sure those debts are cleared rather than giving someone £10,000 and saying go and clear all your debts, because that can just be temptation to maybe clear half the debts and go on holiday or something, you know. So yeah, we are very good at just making sure that that slate is wiped clean at completion. And just to loop back around to where I kind of started, really, the idea is that no one should be on the specialist with a specialist lender for more than 5 years. You know, you're going to do whatever your fixed period is, and as long as your client keeps up their end of the bargain, they will be in a position to move back to the high street at the end of that term. But more importantly, you would have probably gained a client for life because you've helped them through their hour of need. You know, they probably didn't think they had an option. So actually, you get managing to get them that mortgage when all else failed, they will really appreciate it and probably be telling all of their friends about it as well. So referrals can kind of roll in off the back of it. But just in case you were wondering, we do accept business directly. We do probably about 95% of our business direct these days. Okay. However, I know that you do have an internal packaging route, and I've got a good relationship with Derek. So if you're thinking actually, you know, maybe it's better just going through that route, you do have various options, but don't be scared of using us direct. And more importantly, lean on me and your telephone BDM, because if you've got a case on your desk and you're thinking, right, I remember that guy was talking about some of the stuff they did on the specialist market. Maybe I'll pick up the phone. You'll find that we are very contactable. And this, as I said before, even if you call the main line, you speak to underwriters. So hopefully that gives you a bit of an interesting insight into some of the specialist market. Any questions off the back of any of that at all? No, I'm going to stop sharing. Um, but yeah, I don't know if no one's got any questions, then thanks very much for having me. Really appreciate it. I can share the slides with you. Um, and yeah, if there's nothing else, then
Thanks.
I'll leave
Yeah.
you to it. Yeah.
Thanks, Sam. Appreciate that. Very interesting. Thank you.
Thanks so much for having me. Cheers, Mohan. And bye,
Cheers.
everyone
Bye bye.
else.
Bye
Cheers.
bye. Bye.
Bye.